You're tuned into the It's Real podcast with your hosts, Kayla Kallander and Andrew Yaggie. Each week, we'll talk about what happens behind the scenes working full-time in real estate and share with you real-life stories, our successes and failures as we work to help consumers and industry professionals reach their real estate and real-life goals. Here we go.
We're on episode 118 of the It's Real podcast. I'm Kayla Kallander. I'm a mortgage lender.
I'm Andrew Yaggie. I'm a real estate agent.
Hi, Andrew Yaggie. How are you?
Kayla, I am fabulous.
Fabulous. Oh my gosh. Tell me more.
It's the start of a new week. I had a great weekend, a little bit of family time, a little bit of time working, a little bit of flying time. And yeah, just gearing up for just kind of another week of adventure, some real estate, actually getting away to with my kids, my family, and my wife down to the Twin Cities. We kind of have a back to school tradition where we go to Great Wolf Lodge. It's kind of it's a water park in Bloomington, kind of by the Mall of America. And then we usually hit up the MOA for a little shopping and Nickelodeon Universe. Got to go to the Rainforest Cafe. We'll see. This might be the first year where none of the three girls are afraid of like the gorillas that are there.
You either?
Yeah, me either, right? So yeah, we'll do that and go spend some time with a little bit of family and then kind of back midweek. So yeah.
Love that. That's awesome. I bet they're excited. How long do you stay there then? Just a couple nights?
You know, we kind of get there. Last year we stayed for 2 nights, but this year we're just going to stay for 1 night, do water park kind of this afternoon and into the evening, and then tomorrow head to MOA and
fun. Yeah. Oh gosh, yeah, school is amongst us. People are starting, kids are back in school. Summer flew by. I'm sure you feel the same way.
Tell me about it.
Yeah.
So what's up with you? I'm sure you had a little time at the lake. Actually, I think you had a lot of time at the lake. I was around a little bit, maybe not even this weekend, but it looks like you kind of hosted kind of a fun group.
Yeah, I did. So I've been meaning to use my lake home as, a source of just hosting family, friends, business partners. And so finally I did a women in business event, invited a few people from, Fargo and said, hey, come to my lake cabin for the day. Let's have a boat ride. Let's have, some good food. Let's connect. And so I had a few women show up and we took the boat out and we had brunch, and yeah, it was just a daily thing. So I did that on Wednesday, middle of the week. And so it just seems to work better than, Fridays when closings happen. But really beautiful weather. And then I stayed there and worked from the lake Thursday, Friday, and Taryn and the dogs joined me. So yeah, we had a beautiful weekend and we hosted some friends on Saturday. And I love the heat. I love the humidity, but this weekend felt so good without just 90 degrees and humidity. It was so pleasant and comfortable. And yeah, and the lakes are quieter just because, as I've talked about before, it's like after the 4th, people kind of, get back in their other routines, or, people aren't hosting as much, or they're back to school. So it was a really quiet lake weekend on our lake.
Mm-hmm. I did make it out to Otter Tail just briefly to see my parents, and my sister and her husband and family were out there. They just had baby number 3, their 3rd daughter. And so she was 12 days old. So got to meet her and hang out a little bit, but had a lot of other things going on, so couldn't hang out there. I've got a question for you on your lake property, since you're pretty financially savvy, so you're using it to host people. You're using it a little bit for business. Have you ever heard of the Augusta rule?
I have heard of it, but I couldn't tell you what it is.
So the Augusta rule, from what I understand, it was basically named for, like Augusta National for the golf tournament, because a lot of people would come down and like they would rent their properties out, or they would use it as kind of like, hey, we're going to have a retreat, or we're hosting people here and we want to deduct that. So the Augusta rule basically says that any individual can rent a personal residence out for, I think it's like up to 14 days per year without paying a federal income tax on the rental income.
Mm-hmm.
So you could rent it to a separate business entity for, legitimate meetings, retreats.
Mm-hmm.
So
I've heard the 14 days too. We've talked to our financial advisor and our accountant to talk about could we do this? And those, there are ways. I think you're right though. I think it is 14 days. So
Yeah.
something to think about, because I mean,
write those dates down. Write them down right now. Pull your remarkable out and make it out.
I have my remarkable right here.
Things to talk to the CPA about this year.
Oh yes, no, but I think it's always worth looking into, right? Like you just never know. And I think a lot of people don't stop and realize what they can do, like tax advantage wise, and they just assume. And sometimes all it is a conversation to figure out how to best utilize your money and not have the government take your funds, basically.
Well, and again, we talk often, Kayla, about having experts in your life and just the benefit of, not only your sphere, but just having the expertise, the trusted advisors. I've been talking to my CPA a lot recently about, as we're kind of working and transitioning out of residential single and multifamily rentals into maybe some more commercial, and kind of looking at, 1031 exchange versus, hey, what would this look like even if I just said, hey, I want to, this isn't going to work out on one property. What would it look like paying, capital gains and depreciation, which doesn't look great, but it's good to know everything. And then even like the other day, I had someone come to me and say, hey, I'm doing XYZ. I haven't always done things above board, financially. I haven't filed, taxes in like 10 to 15 years. I'm a little bit nervous because, hey, I'm trying to make some adjustments with my business, whatever. And so I was even visiting with my CPA about that. And in Minnesota, at least, and maybe it's federal, but there's like a 3-year statute of limitations. So they could never look back prior to those 3 years. And then, of course, it just depends on what do you have for income? What did you get, a 1099 or a W-2 or, whatever for. So kind of interesting, just, learning all the time when it comes to all things financial.
Always. We had a client the other day that didn't realize his accountant hadn't filed his taxes. And we're like, we need them for your loan, and had no idea. And we've actually seen that happen a couple of times where they think they're filed, they're not. And it's like, sometimes I think people just trust the expert. They trust, but they don't verify, and they just assumed it was done. And so we couldn't help them with a mortgage until they were self-employed. So they had to have their taxes done for us to see, what they're making, what they're writing off. So it's just interesting to see how involved people are too with their accountants.
I think at the end of the day, we all need to kind of work to become our own experts, or at least have knowledge or some subject matter knowledge of whatever it is we're diving into. I look at that with healthcare. I look at, Western medicine, by and large, like there are a lot of negatives to it. And even, going in for a simple physical, is that really, what you need? I think you've got to be savvy, proactive. Same thing, even like when I work with my CPA, I do a lot of research on my own and kind of think about, hey, what are my goals? What are my objectives? I don't have a financial advisor anymore because frankly, the advice I was getting were self-serving, to that individual in terms of some of the funds they were, in which were really stacked, to favor them and the commission they were receiving. So I think there's just so much data, using AI as a sounding board, using friends. I think there are a lot of things that you can do, a lot of ways you can go about it. But again, I think it behooves all of us to go out and to become knowledgeable and, to be invested, in your own life, in your own matters.
Yes.
Because we can't always count on others to do it for us.
You have to advocate for yourself. Same with like healthcare, same with anything. Like, yes, there's experts out there. Yes, they know, but you have to educate yourself as well. And now we have so many tools that there's no reason not to, and again, too, I have to be careful with that because I have a lot of clients that go to Chat or Claude and they're like, hey, I'm asking you all these questions. They don't even know the questions they're asking me. They're just asking to ask. So I think, there's a good balance.
Existence some days.
What's that?
I said it's the bane of your existence some days.
I mean, I could go off on this. I had 3 clients last week, Andy. One of them came to me with a loan estimate from another company and said, hey, Kayla, can you get any more competitive on your rates? In which I replied, these rates are not as competitive. You're paying $12,000 for the rate. If you want to pay $12,000, the rate is much lower. And they're like, oh, and we've gone into extreme detail. Like, you guys, like, this is the rate. at no cost. If you want to spend $1,000 or 10 grand or 20 grand, the rate's going to go lower. So they sent me a competitor's quote and it was higher. And then I had another client that we're going conventional because it's the best program. They have great credit. They have money down. I mean, why wouldn't you go conventional? Because it saves money and it's a stronger offer and you don't have FHA mortgage insurance for the life of the loan or an upfront funding fee, less stricter appraisal requirements, things like that. And they sent me a loan estimate from another company for FHA. And she's like, hey, the rate's lower. And I said, it's actually not the best option though. And the rate's lower, but your mortgage insurance is higher. And I finally said, do you trust me or not? Because I've ran like 30 options for her. And she's like, I trust you. But I share that because I think a lot of people are influenced by AI to be like, make sure you check out this. And then they're just overwhelmed. And so they just shop and spit things out at you. And they just, to their defense, they just don't know. But again, trust but verify, but also don't be cynical either. Like, don't think the worst about the expert, because some experts do have your best interest in mind.
Things that make you go,
Yeah.
We don't see a lot of, pushback, from, AI guided conversations and the like. A lot of people that come to us, they kind of know what they want. Some don't, I guess, but even like on the listing site, like a lot of people have vetted us. And a lot of people have vetted you too, I'm sure, but some more moving parts. And when it comes to spending money and rates, and everybody always just preaches rate. So I can see, how it's challenging, but we don't have a lot of those problems. And for that, I'm very grateful.
That's good. And I think that that's the hard part. Is I was talking to my husband this weekend and I'm like, if you go get a quote for a paint estimate or window treatments or what have you, usually the quote is the quote. With mortgage lenders, the market moves constantly. And so, people are shopping us on August 24th and then again on the 26th. And I always tell people, shop your lenders on the exact same day and time on August 24th between 9 and noon, because then rates are going to be somewhat similar, even though the market moves. But there's so many people that shop on different days. Well, by that point, they're going to go to this lender and they're like, oh, Kayla, you're better this day than this other one was a week ago. But in reality, when they go to lock, then it can change, it can shift. So in our business, it's hard because we can quote you, but it's only good until you're ready to lock it in or until you're in contract. So it's a quote, it truly is a quote that can change. Where just other industries, it's more solid, it's more accurate. Like it can't really move. I could be wrong. There could be other industries that it moves, but.
Well, not to mention, I feel like, okay, there's an obvious level of transparency in mortgage because you have to provide, an itemized estimate, but still, despite the transparency, there still is a lot of smoke and mirrors.
Yes. And I think that's where I've always told people, like, I have a client, he was working with another lender and I said, oh, I've never heard of that lender. And I look and the client has done about 6 deals year to date. Andy, that's not a lot of business. And I know people have to start somewhere, but there's so many individuals that are doing this part-time or just kind of dabbling, or they send an email and say, yeah, rates are this, but until like you're ready to lock, that is just one piece of the puzzle. The other part is reputation, communication. We just had an offer accepted because the listing agent was like, I know Kayla's team, they're going to get this done. There's also peace of mind, so there's just a lot more to it than just what a rate is on August 24th at 9:55 a.m. There's just so much more that matters. But until a client realizes it or they get into it and then they're like, oh crap, can I switch back? It's like they almost learn by being burned. I hate to say that, but sometimes that's how consumers have to learn,
Right.
So.
Well, and I think that's the challenging part sometimes is consumers often don't know what to ask. So what do we ask about? We ask about price, or I guess in this case, second to price rate. Those are the most important things, except they aren't necessarily. I was impressed, Kayla, when I saw this HousingWire article, the 2026 halftime report, and kind of talking about it. And not only was it a great article, but you were also mentioned in here.
Yes.
Let's US. So this talks about a lot of different opportunities in real estate. And so obviously opportunity 36 trillion in equity. So homeowners talked about this in the past. They hold roughly 36 trillion in equity against 12 trillion in mortgage debt. So credit cards and auto debt is priced well above today's rates, which turns a debt restructure and review into a financial planning conversation instead of a rate conversation. Kayla Kallander, a top North Dakota producer, builds retention on annual mortgage reviews and refi readiness plans. So first, congratulations being a part of this article. But again, I look at my own experiences in the past 6 years in real estate. I look at my own mortgage experience. No one's ever asked me, hey, do you have any debt that it would make sense? And maybe they know just from pulling credit reports to see, no, you don't have credit cards, you don't have auto debt. But I look at that and I think that's really awesome because, again, even lately, I'm seeing people get progressively lazier, agents, lenders, people in general, and just like, hey, yep, we'll give you a letter. And then the consumer or the client's like, wow, like I don't even understand what I'm approved for. No one's taking the time to educate me.
I get real passionate about that. So I think it starts with the realtors. I think that if realtors really held like their own, like you do, Andy, you're like, hey, go talk to a lender, get a plan together. What I'm seeing is people wanting to put the offer on the house before we've even talked. So we're rushing. We're like, okay, let's get the letter. And then they don't ever hop on a call with us, but we're like, hey, you're qualified. But I can't tell you how many times, Andy, that I've been able to pre-approve someone for much more if we reallocate their equity from their sale. So let's say they're selling a house and they're going to net 200 grand. If they paid off all their debt and put 5% down, they could afford more because all of their debt is at these higher interest rates. And so I had a client the other day, he goes, Kayla, I've bought 5 houses and no lender has ever told me that maybe utilizing my equity from the sale is better to pay down debt. I never thought of that. And I think that's where we need to slow down as an industry. If we truly care about our clients and we're really advocating for them, we need to slow down and have conversations because I see realtors all the time have buyer consultations. Where do you want to live? What's the neighborhood? You talk to their spouse, or do you want to be, in this school district? And what are your wants and needs? Why aren't people taking the time to talk to their mortgage lender about the biggest financial purchase they may ever make? And that is what always gets me. So in this article, I say, I don't want to be the quickest at providing a letter. Although we are pretty quick. I think that we are very swift. I don't want to be known for that. I want to be known for the advisor, the educator, so that when a client gets to the purchase agreement with you, Andy, they're like, I already know, I feel good, Kayla's talked to me. Or there's 6 other options that they didn't know about, like, a bridge loan or a recast, or maybe they have a cosigner that they didn't think it was possible. So there's just so many different avenues that we could explore. But we have to kind of slow down and just say, what are the options? What are your goals? And both the realtor and the lender should each be having a consultation.
I don't care. I just want to know the rate. Just tell me your rate.
Well, and lately what I've been saying is, for example, the rate is between 5.875 and 6.875 because that's the truth. Are they going to pay money to get the lower rate, or are they going to take the higher rate for no cost? And so then clients are like, well, what do you mean? I'm like, the truth is you have like 10 options if you want. Also, you're a first-time buyer, so there's now another dozen options depending upon how much money you make a year because it's income-based, income-driven. So I've really started to be very, very upfront with clients. Like, yeah, I can give you a payment, but it could shift about $1,000 depending on specials, depending upon how much you put down, depending upon rate. So not to sound like, like I'm joking around with people, but the truth is it really could shift that much. So we're shooting from the hip otherwise. Sorry, soapbox again.
No worries. Kayla, talk about this HousingWire article. I haven't had much time to look at it, but I suspect you probably have a little bit more.
Yeah, so it's talking about just opportunities as loan officers, really about how you can get in front of people, how you can help more people, how you can educate. And a big piece of this is it's not just about rate. And there's a lot of people that got into their houses thinking, well, I'm just going to deal with this rate for the first year, then rates are going to drop. Well, in reality, rates haven't dropped. So, we talk about not just getting comfortable with the payment, but are you comfortable with the payment in a year, in 2 years? What if you don't get that job promotion? What if, like we talked last time, what if something pops up that you weren't expecting in life? So I think that this article was really good about talking about, it's Dave Savage. He's well known for Mortgage Coach. He has a ton of followers. His big thing is education and providing platforms and tools for consumers. And as he talks about, he says Dave has been recording conversations with loan officers, top producers, and executives since 2012. And in 1,700 interviews, close to 60 this year, he talked about, he got input rather from 200 first home IQ ambassadors, so loan officers. And so this just talks about ways that we are educating our consumers, talking about equity. I talked about the 36 trillion in equity, pulling funds out like I talked about. This also talks about the affordability hangover. And I talk about the whole marry the house, date the rate part. And then JJ Mazzo, who's another loan officer, he does a great deal of business. He talks about everybody's just staring at this mortgage rate. And in reality, people are just looking at their 4% rate, but they're forgetting that they're paying 24% over here on a card or 12% on a consumer loan. And Andy, I can't tell you how many times I've asked a client, what are you paying on that loan, on that auto loan? And they don't know. There's such a focus on just the mortgage piece that people often don't take the time to really break down their lifetime rate. Meaning, if we took your 4% rate on your house, your 12% rate on your car, your 24%, what if we accessed your equity and paid that all off? Then you're going to have so much more cash flow to afford a house at that 6% rate. So it talks a lot about the trust and the education of the consumer.
Mm-hmm. I like that. It's a good article. And I think very interesting, that there's someone out there curating the conversations and, saying, hey, what are you learning? What are you seeing? And really just, kind of trying to help everybody, lift the ship in the name of serving people better. A big part is using education. So that's always fun to see.
Well, and there's not always a one size fits all for everybody. There's not just one option for every person. There's multiple options for each people, and every single person is going to have a unique situation. And it's about getting to the root of what's important to you and what's your unique financial, footprint, basically.
Mm-hmm. Awesome. Kayla, do you have time to talk appraisals today, or should we save that for another episode? Yes, no?
Oh, hey. I didn't hear you. What was that?
Oh, we're maybe having a few connection issues. I was just asking.
I'm sorry. We had some technical difficulties.
Yeah. If you had time to talk appraisals today, or if that's a big enough topic we should save for another time.
Why don't we touch on it? Why don't we touch on it today, and then let's go deeper next time? I would love to touch on it today.
Okay. I think that's a good idea. So obviously, most people, when they're buying a home, they're, getting some type of financing. And part of that process is the fact that, hey, we have to have an appraisal done. What's an appraisal, Kayla?
It is a report of the value of the property. So a lot of people think that a home inspection is the same as an appraisal, and it's not. A home inspection is really designed to help find all the things that could go wrong, are wrong, age, just the structure of the house, the condition of the home. Whereas an appraisal is going to tell us the value. And so most loans are going to require an appraisal, not all, depending upon a client's situation. Sometimes you get an appraisal waiver, but an appraisal is done by an expert. Typically, there's a panel of appraisals. Usually, companies have, round robin. We can't just go pick an appraiser to, appraise a property. And it's picked up, and an appraiser goes out, looks at the home, and provides comparable sales, which also impact the value of the house that you're buying. And so what it does is, a lot of people forget that an appraisal is just not the value of the home, like what you pay for it. It also looks at comparables to see what other what other properties are like your subject property, because that can impact your value. So although there's a lot of factors that can go into an appraisal, it is an appraiser's opinion. I always say the appraisal is kind of what you're willing to pay for it, but also they take into account sales that have occurred that are like your property. A lot of people think, Andy, that, well, that house across the street sold for $800,000, but it's a Rambler and it was built in 1990 and yours is new construction and it's a buy level, so it's, even though it's in your neighborhood, it might not be a comparable sale. But a lot of people forget that that is a big piece of the value of your home. So that is something that the bank will order. We have no control over the actual value. But what I want to talk about today is what happens when we get that report. What happens when a property is, basically appraised? And I will share that we get the report, but here is something that most people do not know. Just because we get the report does not mean it's cut and dry, we're ready to go, here's your copy. We have to put it through underwriting review. And why is that important? Because I can't tell you how many times we as an organization have to go back to an appraiser and say, hey, can you talk about this comp? Hey, can you tell me why you adjusted it this much? Hey, this is incorrect. Can you tell me more about XYZ? And sometimes, Andy, that can shift things like the value, or maybe we need a different comp. And so until it's final approved by underwriting, we don't release it because it's not final. And so that is something I've realized our industry doesn't know, is just because we have the copy doesn't mean that it's ready, set, go. And that's a lot of people get worried about the appraisal. So I share that because sometimes you have to be patient. You have to be patient and just wait for it to be viewed. And I told a realtor this the other day. She's been in the business a decade and she goes, Kayla, I didn't know it had to go through review. And I'm like, yeah, it's like, just because it's due on the 20th and we get it doesn't mean that it's ready to go. We take a look at it. But also, Andy, it's not public. No one else knows about the appraised value aside from the client. Even the realtor representing, we have to have permission to send the appraisal to them from the client. The seller doesn't know and the listing agent doesn't know. And that's something else that most people don't know. They think it's just everybody knows. No, if we have an appraisal that came in 50 grand high, our buyer gets to know that. Then they can share that with their realtor, but that is not for the sellers to know. I'm sure you knew that because you represent a lot of sellers.
We work predominantly with sellers, and that's always a big, piece of frustration for people, Kayla, just from the standpoint of it's like, okay, the appraisal's back and it's good. It's cleared underwriting. That's really great. But what did it appraise for? Mm-hmm. I often have to say, well, purchase price or better, but unfortunately, we won't necessarily know. I can certainly ask, but not everyone's always willing.
Mm-hmm.
Share that kind of like a home inspection, Kayla. Like the home inspection belongs to the buyer, and the buyer isn't necessarily going to share that with us unless there are specific asks that they have. And frankly, we may not want to always know about inspection items because, hey, if we know, we have to disclose it. So, but that's getting off onto a different tangent. But appraisals are very, very interesting. We both could share scores of stories from, appraisals that have gone really, really well. And hey, it's business as usual to, hey, the appraisal came in at value and we still had a problem, to, wow, the appraiser never showed up and neither agent on either side followed up, at which point a deal ended up falling apart because the appraisal never got done. It wasn't one of my clients, but I ended up getting a listing, actually, because they fired their agent.
Oh, no.
Things went south, but very interesting.
Yeah. Well, and I think a lot of people forget that an appraisal is typically going to be required. A home inspection is typically optional because you're going to talk to your agent if you should, make a contingent on a home inspection. But they're two separate things. And we don't get a copy of the home inspection, Andy. As a lender, we don't. We rely on the appraiser to, if he sees or she sees any concerns, she calls it out in the appraisal. So we go off of what the appraisal says. Often we see subject to. Subject to appraisals mean that there is something that needs to be fixed or remedied. Safety, sound, structural. It could be scraping and painting windows because of the property. when it was built, the age of the property, and its FHA. It could be new construction. We always get subject to because it's not done yet. So the appraisal will say, this is the value subject to the completion of the home by Heritage or Dabbert or Thompson. So we see a lot of those, but I just think it's important to know that one, lenders do not hold appraisals hostage. Once we get them and they're reviewed, my team anyway, we're spitting them out immediately. Two is that we don't have control over the value. I hear a lot of people say, well, if we switch lenders, well, I mean, you could, but at the end of the day, that same appraiser could get it. And three is that the value of the property is one piece. The rest, the comps, if you've ever seen an appraisal, it can be, 24 pages. And it's important to know that that has to be reviewed by the bank, by the mortgage company before it's released, because there could be some things that shift. Andy, I had a file last month and it was valued, and they had written some things in the purchase agreement that said, we have a commitment date of this day, meaning the loan has to be final approved. Well, we found out the value at 8 p.m. that night. And I said, hey, the value's in, because then they wanted to do negotiations if they could. And the value, you guys, is where we need it to be. It actually came in higher than offer price, Andy. But I said, it still has to be reviewed by underwriting. Andy, it was a jumbo product, meaning a riskier loan.
Home.
What's that?
So an expensive home.
An expensive home. Yes, very expensive, and hitting nearly $2 million. And the underwriter looked at the comparables and realized that the appraiser had made such huge adjustments from the comps that it was risky. So basically they said, we need another appraisal done, like a desktop where it's just quicker. And it came in, Andy, 400,000 short. Ooh. So basically stating that appraisal, yes, it's important that they give their opinion, but the data did not support it. So we were at a point where, okay, do we get another appraisal? And if they use comps more like that property, then we probably would see that value come in a lot shorter. So I share that with you because appraisals, although so important, it's not necessarily the lender that's in control. There's a lot of steps that have to take place before it's released and provided to the client.
Well, I feel like we've obviously a lot of information just shared, but I feel like we've only tipped the iceberg. And I feel like there's a lot more to talk about. In fact, I've got some pretty crazy appraisal stories too, but I think we should save that for next time, Kayla, where we talk more about appraisals.
I would love that.
The deal isn't done until it's done. So let's do that.
Any matter for final approval. And we can talk about this too. The deal is not done until it's done, because things can pop up on bank statements. Clients could lose jobs. Appraisals could come in at value, but might not be a reliable appraisal. So it's not over till it's over.
Yeah. Well, now you know what to look forward to on episode 119. But otherwise, I think that puts a wrap on today. So Kayla, great connecting as always. I hope you have a great rest of the week.
I will if you will. We'll see you later. Bye.